Every dollar in your wallet was created as debt, not printed by the government, created by banks when someone borrowed money. That's not a metaphor. When a bank approves a mortgage, a car loan, a credit card charge, it creates new money that didn't exist 1 second before. And here's the part that should concern you. The interest on that debt was never created. The system requires more debt than money exists to service it, which means the system requires exponential debt growth just to function. And in 2025, that system has reached a scale that's becoming impossible to sustain. In 1971, President Nixon severed the final link between money and gold. Before that moment, dollars represented a claim on something real. After that moment, dollars became pure debt instruments. Every dollar created through the banking system now comes into existence with a corresponding obligation someone has to repay. Your savings account balance exists because someone somewhere took on debt. If every loan in America were paid back tomorrow, there would be no money. Zero. That's not hyperbole. Robert Hemphill, credit manager of the Federal Reserve Bank of Atlanta, wrote in 1936 that if all bank loans were paid, there would not be a dollar of coin or currency in circulation. We are completely dependent on commercial banks. Someone has to borrow every dollar we have. Think about what that means structurally. The money supply increases when banks make loans and decreases when borrowers repay them. But loans charge interest. If a bank creates $100 in new money through a loan at 5% interest, the borrower owes $105. Where does the extra 5 come from? From someone else's debt. The system is a closed loop where debt must always exceed the money supply. This isn't a flaw, it's the design. And the scale has become staggering. Global debt reached $305 trillion in 2022. That's quadruple the world's entire economic output. In the United States, the debt to GDP ratio sits at 278%. That includes government debt, corporate debt, household debt, all of it. For context, in 1970, that ratio was around 150%. The acceleration is exponential because it has to be. If global debt grows at 5% annually, which is below the historical average, it doubles every 14 years. But global GDP growth averages 2 to 3% annually. The gap widens automatically. Each year, a larger share of economic output must go towards servicing debt rather than productive activity. Central banks understand this dynamic completely. They're trapped by it. When debt levels get too high, they have two options. Let defaults cascade through the system, which causes deflation and economic collapse, or expand the money supply to make debt sustainable, which causes inflation and erodes purchasing power. Japan chose deflation after their bubble burst in 1990. Their economy has been stagnant for 35 years. The Federal Reserve and European Central Bank chose inflation after 2008. They expanded their balance sheets by trillions, buying government bonds and mortgage-backed securities to inject liquidity into the system. The Fed's balance sheet peaked at $8.5 trillion in 2022. That's money created from nothing, used to buy assets, keeping interest rates artificially low so the debt burden stays manageable. In December 2025, the Fed cut rates to a range of 3.5 to 3.75%. Continuing an easing cycle that started in September 2024. Jerome Powell, whose term expires in May 2026, emphasized that future decisions will be data-dependent. What that really means is the Fed is balancing two impossible mandates: keep employment high, which requires easy money and low rates; keep prices stable, which requires tight money and high rates. For the first time since the 1970s, these goals are in direct conflict. The Fed is divided internally. Dissents are coming from both directions. Some members want faster rate cuts to support employment. Others want to hold rates higher to prevent inflation from re-accelerating. No decision satisfies both objectives. Meanwhile, the European Central Bank is holding rates at 2.15%. Most economists expect no changes through 2026 and 2027. The ECB is even more constrained than the Fed because it manages monetary policy for multiple countries with different fiscal situations. Germany wants tight money. Italy and Spain need loose money to service their debt. The compromise is paralysis. This is the monetary trap. But here's where it connects to something much larger. While central banks manage the debt-based money system, corporations have been consolidating power at an accelerating rate. Over 75% of U.S. industries are more concentrated today than they were 20 years ago. The top 1% of companies by sales now account for 80% of all corporate revenue. In 1969, that figure was 60%. The top 1% by net income capture $8 of every 10 earned by U.S. corporations. This isn't happening by accident, it's structural. Corporate concentration has increased persistently over the past century. Manufacturing and mining sectors consolidated faster before the 1970s. Since then, services, retail, and wholesale sectors have taken the lead. At the current rate, projections suggest only one U.S. company will exist by 2070. That sounds absurd until you look at sector-by-sector trends. In agriculture, 6 multinational corporations controlled 63% of the commercial seed market and 75% of agrochemicals as of 2013. Then those 6 merged into 3: Dow DuPont, Bayer Monsanto, ChemChina Syngenta. 3 companies now control global agriculture inputs. Farmers overwhelmingly oppose this, an 80% disapproval rate in surveys. But it doesn't matter. The consolidation continues regardless of public opinion. In grocery retail, Kroger, the 3rd largest chain behind Walmart and Amazon, absorbed formerly independent regional chains: QFC, Fred Meyer, Ralph's. During the pandemic, while households struggled, Kroger's operating profits increased by $1.2 billion. Not revenue, profit. The concentration allows pricing power that independent stores never had. And the pattern repeats across every sector: banking, technology, pharmaceuticals, media. Fewer companies controlling larger market shares. But why does this happen? What's driving the consolidation, and how does it connect to the debt-based monetary system central banks created? That's where the structure reveals itself. The connection runs through the monetary system itself. When banks create money through loans, they're creating debt. Every dollar in existence represents someone's obligation to pay it back plus interest. But here's the structural problem. The interest isn't created along with the principal. If a bank loans $1 million into existence, that million exists. But the $50,000 in interest payments due over the loan's life, that money doesn't exist yet. It has to come from somewhere else in the economy. from someone else's loan. This creates a mathematical requirement for perpetual debt expansion. The system needs constant new borrowing just to service existing debt. If lending stops, defaults cascade. Money disappears from circulation. The economy contracts. Robert Hemphill, credit manager of the Federal Reserve Bank of Atlanta, explained it in 1936. If all bank loans were paid, no one would have a bank deposit. There wouldn't be $1 of currency in circulation. We're completely dependent on commercial banks. Someone has to borrow every dollar we have in circulation. If banks create ample synthetic money, we're prosperous. If not, we starve. That was written 90 years ago. The system hasn't changed, it's only expanded. Global debt reached $305 trillion in 2022. If that grows at 5% annually, it doubles every 14 years. Global GDP historically grows at 2 to 3%. The gap widens every year. Debt grows faster than the productive economy supporting it. Eventually, debt servicing consumes everything. More of each dollar earned goes to interest payments. Less remains for wages, investment, or consumption. Central banks respond by expanding the money supply through quantitative easing. The Federal Reserve's balance sheet peaked at $8.5 trillion in 2022. They've been letting bonds mature without replacement through November 2025, shrinking it to $6.2 trillion. But in December 2025, they reversed course. Now they're buying up to $40 billion per month in Treasury bills through April 2026. Not quantitative easing, they call it reserve management. The label changes, the mechanism doesn't. When the Fed writes a check to buy assets, it creates money from nothing. That check gets deposited at a bank. The bank's reserves with the Fed increase by the full amount. No other bank's reserves decrease. Total reserves in the system just expanded. New money created by purchasing debt. This is where corporate consolidation connects to monetary structure. Large corporations have unprecedented access to this newly created money. They borrow at rates small businesses can't access. They issue bonds that central banks and institutional investors buy in massive quantities. During the pandemic, corporate debt exploded, but interest rates were near zero. Borrowing was essentially free. Corporations used that borrowed money to buy competitors, buy back their own stock, and expand market share. Small businesses couldn't do the same. They don't have bond markets. They can't borrow billions at 2% interest. They get local bank loans at 8% if they qualify at all. The result? Consolidation accelerates during periods of monetary expansion. Those closest to the money creation benefit most. This isn't conspiracy. It's structural advantage. Large corporations have finance departments that understand how to leverage cheap debt. They have relationships with the banks creating the money. They have credit ratings that allow borrowing at scale. Look at what happened to the banking sector itself. The number of banks in America has fallen 60% since 1981. Population has grown substantially. Fewer banks serving more people. Some argue concentration ratios actually declined from 2002 to 2012. The top 4 banks' market share dropped from 29.5 to 25.6%. But that misses the deeper consolidation. 3 of the largest U.S. banks, J.P. Morgan Chase, Bank of America, and Citibank, all have the same largest shareholder. BlackRock. BlackRock manages assets in the trillions. Vanguard, Fidelity, and Capital Group collectively manage trillions more. These asset managers own significant stakes in nearly every major corporation across every sector. They vote those shares, they influence corporate governance, they sit on boards. This creates a meta-consolidation above the corporate level. Separate companies, common ownership. Airlines that theoretically compete have overlapping major shareholders. Pharmaceutical companies that supposedly compete have the same institutional investors. Media companies, tech platforms, retail chains, all connected through common ownership structures. The appearance of competition masks coordinated interests at the ownership level. And those ownership structures benefit directly from the debt-based monetary system. When central banks expand money supply, asset prices inflate. Stocks rise, bonds appreciate, real estate climbs. The wealth held by these institutional investors grows not from productive activity, but from monetary expansion. BlackRock's assets under management don't increase primarily because they picked better investments. They increase because the Fed creates money that flows into financial assets. Meanwhile, wages measured relative to GDP have declined since 1970. Total compensation as a share of economic output keeps falling. Income is shifting from labor to capital, from people who earn wages to people who own assets. The 2,754 billionaires globally now hold $9.2 trillion in combined wealth. That's doubled in 6 years, increased tenfold since the start of this century. The top 6 billionaires own as much as the bottom half of the global population, 3.8 billion people. This didn't happen because billionaires suddenly became 10 times more productive than they were in 2000. It happened because the monetary system funnels newly created money toward asset owners. Debt expands, money gets created. That money flows into financial markets. Asset prices rise, wealth concentrates at the top. The people holding assets when money gets created capture the value. Everyone else deals with the inflation that follows years later when that money filters through to consumer prices. You're watching the mechanism in real time. The Federal Reserve just announced in December 2025 that it will purchase up to $40 billion per month in Treasury bills through April 2026. Not quantitative easing, they clarified. Reserve management. The distinction matters legally, but the mechanism is identical. The Fed writes checks that don't draw on any account. Pure money creation. When they buy $1 million in assets, they inject $1 million in new reserves into the banking system. The selling bank's balance with the Fed goes up $1 million. No other bank's reserves go down. Total supply of reserves increases. Money appears from nothing, backed by nothing except government debt that taxpayers will service forever. This is how the system actually functions at the operational level. The Fed's balance sheet peaked at $8.5 trillion in 2022. They let it shrink to $6.2 trillion by December 2025 through quantitative tightening, allowing bonds to mature without replacement. Now they're expanding again. $40 billion per month doesn't sound like much compared to the trillions printed during COVID, but it's the resumption that signals intent. The tightening phase is over. Expansion resumes. And every dollar they create flows somewhere. Where does it flow? Not evenly distributed to every citizen, not direct deposits into worker paychecks. It flows to whoever sells those treasury bills to the Fed, primary dealers, major banks, institutional investors. The money enters the financial system first. Those institutions use it to buy other assets: stocks, bonds, real estate, commodities. Asset prices rise before the money reaches consumer goods. By the time it filters down to wages and prices at the grocery store, the wealth transfer is complete. Asset owners captured the value. Everyone else experiences the inflation. This is structural, not accidental. A 1936 statement from Robert Hemphill, credit manager at the Federal Reserve Bank of Atlanta, laid it out plainly. If all bank loans were paid, no one would have a bank deposit, and there would not be a dollar in circulation. We are completely dependent on commercial banks. Someone has to borrow every dollar we have in circulation. If banks create ample synthetic money, we are prosperous. If not, we starve. We are absolutely without a permanent money system. That was 1936. The system hasn't changed. It's intensified. Total global debt hit $305 trillion in 2022. If that debt grows at 5% annually, it doubles every 14 years. GDP historically grows at 2 to 3%. The math doesn't work long term. Debt compounds faster than productive capacity expands. Eventually, debt servicing consumes more output than the economy generates. That's the trajectory, not theoretical, mathematical. Advanced economies already show the strain. U.S. debt to GDP sits at 278%, not just government debt. Total debt, public and private combined. Every sector over-leveraged simultaneously. Corporations loaded with cheap debt from a decade of near-zero rates. Households carrying mortgages, auto loans, credit cards, student debt. State and local governments underwater on pensions. Federal government running trillion-dollar deficits in a growing economy during peacetime. The entire structure depends on continuous debt expansion, which requires continuous money creation, which drives asset inflation and wealth concentration. The policy framework that enabled this consolidation shifted decisively in 1982. The Reagan administration changed merger guidelines without changing a single law. Strong antitrust enforcement that had prevented concentration since the Great Depression got replaced with a focus on short-term consumer prices and economic efficiency. Courts adopted the new framework. Enforcers followed. Consolidation accelerated across every sector. Manufacturing and mining had already been consolidating prior to the 1970s. After 1982, services, retail, and wholesale sectors took the lead. Today, 75% of U.S. industries show increased concentration compared to 20 years ago. The top 1% of companies by sales now account for 80% of revenues, up from 60% in 1969. Agriculture demonstrates the pattern clearly. 6 multinational corporations controlled 63% of the commercial seed market and 75% of the agrochemical market as of 2013. Then 3 major mergers consolidated those 6 into 3. Dow DuPont, Bayer Monsanto, ChemChina Syngenta. If approved, these 3 will dominate global agriculture. A 2016 survey found over 80% of farmers viewed these mergers negatively. Their opinions didn't matter. The mergers proceeded. Grocery retail followed the same path. Kroger, third largest retailer behind Walmart and Amazon, absorbed formerly independent chains. During the pandemic, while households struggled, Kroger's operating profits jumped by $1.2 billion compared to the previous year. More than $2.9 billion through mid-2020 alone. The system extracts from the many and concentrates in the few. Not through explicit conspiracy, but through structural mechanics. Debt-based money creation favors those closest to the money source. Corporate consolidation eliminates competition and raises markups. Common ownership through institutional investors aligns interests across supposedly competing firms. Political influence through campaign finance and lobbying shapes. Regulations to protect incumbents. The pieces fit together into a self-reinforcing architecture. You can't opt out. You participate in the debt system every time you use dollars. You fund consolidated corporations every time you buy food, fuel, technology, healthcare. You're embedded in structures built over decades, refined through crisis, protected by regulatory capture. The question isn't whether you're in the system, you are. The question is whether you understand how it works and position accordingly. Own assets that benefit from monetary expansion. Recognize that wages will continue losing ground to capital. Understand that consolidation will continue until structural limits force change. Those limits approach faster than most people realize. Global growth projections show deceleration from 3.4% in 2025 to 3.2% in 2027, the slowest post-pandemic pace. Central banks face conflicting mandates reminiscent of 1970s stagflation. The math says the current trajectory is unsustainable. What comes next depends on DC. Science made in the narrow window that remains. The system built over the past 50 years won't reform itself. It can't. The incentives point in one direction only. Expand debt, consolidate power, concentrate wealth. Every institution with the authority to change course benefits from maintaining it. Central bankers who understand the mathematical impossibility of infinite debt growth still choose expansion over collapse because the alternative is immediate crisis. Corporate executives who recognize consolidation harms consumers still pursue mergers because their compensation depends on growth. Asset managers who see wealth inequality reaching historic extremes still vote for policies that widen it because their clients are the beneficiaries. You're left with three options. Pretend the system is fine and sustainable, which requires ignoring mathematics and history. Fight against structures so deeply embedded in law, finance, and policy that individual resistance is meaningless. Or understand the mechanics completely and position yourself on the side that captures value rather than the side that provides it. The system runs on extraction. The only choice is which side of that equation you occupy. That's not cynicism, that's recognizing the architecture for what it is and making decisions accordingly. Because whether you understand it or not, whether you participate consciously or not, the system operates the same. It just determines whether you see it coming. Subscribe if you hate debt.